Hey, Stephen Brooks here, and I teach those who manage their own portfolios, whether they're beginners or experienced, good or bad, to generate a very reliable six-figure salary trading for really less than 2 hours a day. Now, the way we're able to accomplish that with really the overwhelming majority of our students is by getting them to focus on one particular strategy in one particular product, and then really kind of aggressively eliminating every other possible distraction away from that one particular strategy and one particular product. Now, what I'm going to teach you today revolves around buying options. Full disclosure, buying options is not involved in the six-figure salary system. There's a number of reasons why. Number one, they do not come with consistency whatsoever. So for those who are out there looking for predictable, reliable results, kind of like a salary, buying options is by far the last thing that you want to go ahead and do because, again, they do not come with a high success rate. They do not come with the consistency that most people are looking for. Again, if you're looking to build up a big nest egg over time, I'm not the guy for you. But if you're looking to generate income today from your portfolio, tomorrow from your portfolio, the day after that, and then the day after that, and then the day after that, I'm definitely your guy. Buying options is not the best way at all. It's probably one of the worst ways to be able to go out there and generate, again, consistent, reliable, and predictable profits like a salary. So what we're going to do in this video is I'm going to prove to you why buying options absolutely sucks. And then I'm going to show you if you're one of those people out there who must, for whatever reason, buy options, if you stick around till the end, I'm going to show you actually, based on the data, based on the numbers going back to 2007, what the data says in terms of what is the best type of trading when it comes to buying options. And even the best is still really not very good because it really doesn't have the consistency that you're looking for. So if you're one of those people who just has to buy options for whatever reason, this video is going to be substantially better than any course or guru or whatever you would pay for on the internet. This is going to be substantially better than that. So let's go ahead and kind of dive right in. Why buying options sucks. Now, most of you who just for whatever reason have to buy options, right? Most of you, the reason that you actually do this is because, well, they're inexpensive, right? You can buy an option for $100, $200, $300. So compared to some of the other types of trades out there, buying options are the least expensive choice, right? You don't need any sort of margin approval or higher level option approval to be able to go out there and purchase a simple call or purchase a simple put. You just need the money that it costs to buy the option in the account. At the same time, because it is something that is done for a debit, right? You are paying the money for that contract, right? You can only lose the amount of money that you put up. So if you buy a contract for $100, you can only lose $100. And at the same time, probably the biggest draw or one of the two biggest draws when it comes to buying options are, again, number one, you can only lose the amount of money you put up and they're cheap. But number two, the upside is 100% unlimited. There is no limit to the amount of money, to the amount of percentage return. There is no limit to the ROI that you can make or earn on buying options. So, everyone who has been sold something by a guru has probably seen that the 1,200% return, the 1,500% return, the 500% return on options. That is totally possible. The odds of you doing that are very close to zero. But again, there are a number of reasons why people are just obsessed with buying options, even though if they looked at their track record, they would never show that they worked. But for whatever reason, for these reasons, people, individual traders, those who manage and trade and invest their own portfolio, still have this obsession, even though it doesn't make them money consistently, reliably, or predictably, they still have this obsession with buying options. Now, there's two reasons why buying options sucks. The two reasons are under the basket of you have many things working against you, right? The stock market, you can make it complicated or you can make it easy. If you want to make it complicated, why not do the things where you have more things stacked against you? if you want to make it easy, why not do the thing where you have more things stacked in your favor? So when you buy an option, in order to be right, you have to be right on the direction, right? So if you buy a call option, that stock better go up. And not only do you have to be right on the direction, but you have to be right on when that directional move happens. So for example, when you buy a call option, you have to be right on when that's going to happen and how far in that direction it's going to move. And when you buy a put and you're hoping that the stock goes down, you have to be right on the timing of the stock going down and how much it goes down. Right? I remember a long time ago when I was a crappy trader and I used to consistently lose money, I bought a call option before an Apple's earnings announcement. The stock went up. I thought the next morning I was going to see all this brand new money in my account, and I had lost money. I did pick the direction, but I didn't get the pace and the actual size of the move correct. So when you buy options, you have a number of things working against you. And again, you can make the market easy, you can make the market hard. Most people, for whatever reason, choose to make the market super, super difficult. And kind of the number one way that they choose to make the market super, super difficult is by placing the types of trades, doing the things that where the odds are stacked against you, where the odds are not in your favor. So at the end of the day, if you're going to be out there and you're going to buy options, you cannot do it at the time where you have a number of things stacked against you. Again, I'm going to repeat that one more time for the people who are paying attention. If you're going to buy options, blanket statement, it needs to be at the times where you do not have multiple things stacked against you. Again, you have two things that are always stacked against you when buying options. It would be a lot better if you were to buy those options when only one of them was stacked against you. So at the end of the day, we have to eliminate or try to eliminate one or both of these things so that we make it a little bit easier for ourselves and we don't have two things stacked against us when it comes to buying options. So if you must, after you've consistently lost money buying options, right? After you've had a win rate via buying options of far less than 50%, if you still, for whatever reason, must buy options, again, you have to eliminate one of these two. And the good news is we can actually eliminate one of these two if we just think a little bit. So what we're not going to be able to do is we're not going to be able to get around the fact that when we buy a call option, the stock has to go higher. Or when we buy a put option, the stock has to go lower. We're not going to be able to get around that. But what we can get around is the timing of it. And more specifically, is the pace of the move. We can actually get around that a little bit. So there are times when instead of two things being stacked against you when it comes to purchasing options, there is only one. And that happens before a stock announces earnings. So we're going to show a bunch of examples here over the course of this video. We're going to show you actually the best types of trades to do and exactly when it comes to buying options. But suffice to say, the only time where you don't have two things going against you when it comes to buying options is before a stock announces their earnings. Why is that? Because volatility increases going into a known unknown, into a known binary event. So everyone knows when these stocks are going to announce their earnings, right? Everyone knows that, but nobody knows what the actual earnings are going to be. And then nobody knows, based on what those earnings are going to be, actually what the reaction of the stock is going to be. Nobody knows that. But when that whole thing is going to happen, when that announcement is going to happen, and when that subsequent move in the actual stock is going to happen, everyone knows that. So what you can see here on the screen is a really good example in Macy's, right? What we have is we have a measure of volatility known as implied volatility, and that is the expected move in the stock. What you notice is going into an earnings announcement, which is here, here, and here, we have a rise in implied volatility. Why do we have a rise in implied volatility? It is because, again, everyone knows that this is when Macy's is going to announce their earnings. Everyone knows it could move the stock quite a bit. So because of that, implied volatility rises into the earnings announcement. And then as soon as that earnings announcement happens, when it becomes a known what the actual result was and the subsequent move of the stock, volatility crashes. Same thing, next earnings. We know that this is when Macy's is going to report their earnings. We know there is more potential on an earnings day than other days when the stock could move quite a bit. So what happens to volatility? It increases into earnings. And then after, it crashes. Same thing. Everyone knows, the world knows, this is the day that Macy's is going to come out and announce their earnings. Everyone knows that. And because everyone knows that, everyone also knows that there could be a fairly large move on that day. Could be very good earnings, in which case the stock goes higher. Could be terrible earnings. But everyone, it's a known unknown. It is known that there's going to be an actual announcement. It is unknown the outcome of that. So because of that, the market will price in a greater expected move, will price in more volatility, and then after that number actually comes out, implied volatility and that expectation for a large move comes down. So at the end of the day, when it comes to buying options, you have two things stacked against you, right? You have to be right on the direction and the pace of the move. So if you still have to buy options, and again, at the end of this, I'm going to show you times where it does actually work consistently. But if you still must at this point buy options, you have to do it before earnings. Why do you have to do it before earnings? Because you neuter one of these two disadvantages of buying options. You neuter one of these two things against you, and now you're left with only one disadvantage. Basically, reducing the disadvantages by 50% when it comes to buying options. And how do we do that? We do it by buying options, calls or puts, and you'll see here, it's never puts because that never works. It's only calls. But what you see here in a moment is if we do buy calls going into earnings, we can find something that is good. And then if we do a little bit more thinking and a little bit more digging, we can find something that is actually what I would call acceptable. Not acceptable enough for consistent weekly profits like a salary, because earnings only happens 4 times a year, but consistent enough for people who are not looking for a predictable, reliable, consistent salary to probably get much better results than you've paid for when it comes to coaches or alert services or anything you've ever be able to get on your own when it comes to buying options. So again, the only time that you should be buying options is before earnings. Why? Because it is the only time where you only have one thing working against you as opposed to two. So we did a little bit of a study, and we did a number of studies here. So the first one is going back to January 1st or January 2nd of 2007. I'm shooting this at the beginning of 2024. So we're talking about 13, 14 years of a sample size of the top 100 stocks based on volume. Now, during that time, we had the great financial crisis. We had the summer of 2011. We had the summer of 2015. We had the election cycles and Brexit in 2015, 2016. We had Q4 2018. We had COVID. We had 2022. So while the market is higher than it has been going back to 2007, and while the market does go up more frequently than it goes lower, this is a really, really big sample size, over 6,000 trades in this sample size. So to me, even though it is impossible to predict identical results moving forward, when we have a sample size that is many, many thousands of trades based on the high liquidity, high volume names, to me, this is like pretty accurate to give or take what it really should look like into the future. So here's what we did. Remember, we only should ever be buying options before they announce earnings. Why? Because we remove one of the two detriments, one of the two headwinds, one of the two things that are working against you when it comes to buying options, and that is being right on the time or the pace of the move. So now, because we completely eliminate that, because the increase in implied volatility offsets the decrease in the value of options if theta decay. But because we have offset that, well, we only can be doing this, again, before earnings are announced. So what we did is 3 trading days before all of these stocks announced had their earnings announcement, we bought the 40 delta call option in the expiration cycle that expires closest to 7 days, and we placed a 40% profit target and a 40% stop loss. So if we bought it for $1, we look to exit at $1.40 or exit at 60 cents. And again, every single time we bought the 40 delta call option in the 7-day expiration cycle. And again, we entered this trade towards the end of the day in the data, 3 trading days before these 100 stocks gave their earnings announcement. Now, these results are interesting, and I'll go through each of them and I'll give you my thoughts here. So 6,200 trades, 3,000 winners, 3,222 losers. So even though this trade returns about 6% per trade, which when you consider the average hold time is 2 to 3 days, that is an annualized return of 500%. Now, this is where a lot of people get tripped up when it comes to buying options. They see that the average trade is almost 6%, and it's a 2 or 3 day hold period. And because it's only a 2 or 3 day hold period, the average annualized return is over 500%. So a lot of people will have blinders to this information up here and only look at the average trade, again, close to 6%, and the average annualized return, because again, we're only in the trade for 2 or 3 days, being 500%. Most people will look at that and say, I got to do these trades. But here's the problem. I know you. I've worked with over 6,000 individual traders and investors over the past 5 or 6 years. None of you are going to be acceptable to a win rate of less than 50%. You're not. And if you're sitting there saying, I will be acceptable to that, you've actually never invested or traded before. While these numbers are good, again, 6% per trade. The market returns 7 to 10% per year, right? This returns 6% per trade in about 2 or 3 days for an average annualized return of 500%. But very few of you are ever going to be able to get this result. Why? Well, you're not going to do 6,000 trades. So some of the really good ones that really bring up the averages, you're going to miss. Number 2, if overall it has a win rate of 48%, you will be losing more frequently than you're winning. And for non-professionals, it's a big confidence game, right? The 6-figure salary, my premium program, we're winning way more than we're losing. Like 70, 80, 90% of the time we're winning. And that builds a lot of confidence. Here, if you're winning less than 50%, you're not going to have a lot of confidence and you're probably going to give up pretty quickly. So again, most people will look at the average trade and the average annualized result and be like, I'm going to do this. But then when you do this and you don't have a ton of confidence because you're winning half the time at best, you're going to end up giving up. Now, there are a couple exceptions and there are a couple of trades that really, really, really do incredibly well here. And we'll talk about kind of why these trades probably do really good. And again, clearly, like in NVIDIA, the average trade is 13.72%. And again, that's a 2 or 3 day hold period. But the win rate is still 50%. Look at Tesla. The average trade, 41.96%. But the average win rate is only 52%. Right? Even on the best one, ASML, which I believe is also like an AI chip play, 46.57% per trade, but it wins like 58% of the time. Again, I've taught 6,000 traders how to do this. It's a confidence game. If you're not winning way more frequently than you're losing, you're going to throw in the towel, or at least you're going to try something else. So what you'll notice is taking a look at this list of some of the top performers. You'll notice a couple things. Number 1, a lot of them have to do with the most popular themes in the market. So NVIDIA is on here. That's an AI play. Tesla's on here. That's a electric cars and AI play. AMD, AI play. Micron, which is MU, AI play. ASML, chip AI play. So 5 out of the 9 names on this list are very, very specific to like the AI chip theme. So it is interesting to consider and think about the fact that, well, maybe doing this in the sectors that are really kind of popular, maybe that will give me a better result. The problem is this: even doing that, your win rate is still going to be wrapped around 50%. And that is going to make something that looks really good on paper not really very realistic in the real world. So to me, just blindly buying these call options 3 days before an earnings announcement, while it certainly is at the right time, and it certainly does eliminate one of the two headwinds, one of the two things that are always working against you when it comes to buying options, it just doesn't have the win rate that is going to be acceptable to a non-professional trader. So let's try 7 days now. Maybe we can get a better result on the 7 day than the 3 day, because again, it's still about doing it at the right time. And 3 days before earnings, although it does give a positive return per trade, it doesn't come with the win rate that is going to allow the majority who are watching this video, who are non-professionals, to really stick with it long enough to get a positive result. So let's try 7 days. So 7 calendar days before the earnings announcement, we bought the 40 delta call option. We placed a 40% profit target and a 40% stop loss, 7 days to expiration. Now, these results are very much in line on the 7 day compared to what we saw on the 3 day. So we have a win rate of less than 50%, 48%. We do have an average trade of 6.14%, which on an average 6 or 7 day hold, comes out to a very large annualized return of like 320%. But again, don't be so distracted by the fact that you make 6% per trade, you make 320% on an annualized result, because again, you need to be winning 70, 80, 90% of the time for you to stick with it long enough to get the results that you're looking for. And again, very similar to what we saw on the 3 day to expiration, there are a number of names on the 7 day to earnings announcement that really bring up the averages, but still, their win rates are still wrapped right around 50%. Meaning, again, I've worked with 6,000 traders, investors, people who manage their own portfolios. None of them stick around for a 50% win rate. They only stick around for, 65, 70, 75, 80, 85, 90, 95% success rate, because you want to be winning way more than you're losing. And even though some of these numbers are really good, right? Broadcom's on here, Adobe's on here, PDD is on here, Walgreens is on here, Goldman Sachs is on here. Although they're on here, again, in order to get these kind of results, you have to do a lot of trades. You can't pick your spots. You have to have a big account. You have to do a lot of different trades. And even then, you're winning less than 50% of the time. It does create a challenge in terms of having confidence to go out there and be able to get predictable, reliable result each and every week, similar to a salary. So even though the numbers are positive at the 3 day level, and even though the numbers are positive at the 7 day level, it's still giving you a win rate that's like not way below, but it's below 50% to the level where, again, I've worked with 6,000 of you. None of you stick around for a 50% win rate. That's just not how human psychology operates for non-professionals. So if the 3 day didn't work and the 7 day didn't work, maybe 14 days, 14 calendar days before the stock announces its earnings will do it. So what we did was this. We still bought the 40 delta call option. This is wrong. There we go. Now that's right. So we bought the 40 delta call option 14 calendar days before the stock was set to announce its earnings. And we did it in the expiration cycle closest to 30 days. So again, like the results that we got on the 3 day were positive, but the win rate was less than 50%, meaning it's not going to work for the average person. Same thing on the 7 day, right? Positive returns per trade, positive annualized results, but still that win rate less than 50%, not going to be feasible for the average non-professional. Let's see what the 14 day was able to do. So again, very similar results. In fact, the 14 day out of all these had the lowest win rate. So 46%. Again, I've not seen a non-professional stick around for a win rate of less of 50% or less. Now, the average trade is high on this, 15%. But again, you're going to be losing more frequently than you are winning. And there are outliers that are exceptionally good. And this one is actually kind of interesting because Microsoft's on there, Nvidia's on there, Google's on there, Broadcom's on there, Netflix is on there, Applied Materials is on there, Goldman Sachs. So really some of these popular names are on there. But again, in order to get a result like this, you have to do a lot of trades. Your account has to be big, and you also have to be the outlier as a non-professional investor or trader who is totally okay losing more than winning. So really at the end of the day, to me, the problem with these results, although positive, right? To me, the problem with these results is, number one, you have win rates of less than 50%, right? Again, I've worked with 6,000 individual traders, some who have made millions, some who have made hundreds of thousands of dollars, many dozens who make a consistent and reliable $5,000 to $10,000 a month. None of them are acceptable to a win rate that is less than 50% because, again, this is a confidence game for non-professionals. So my big problem with the results, even though they're positive, is number one, the win rates are less than 50%, meaning it is not realistic for the average non-professional to get the results that you see here. It's just not realistic. You're not going to be able to get it, even though these are what the numbers are. The reason why is because you have to do a big sample size. You have to be okay with a low win rate. Plus, you can't pick your spots. So you need to have a large account, and you need to basically do all of these every quarter to be able to get that average trade, which is about 15% in about 2 weeks. So ultimately, the two biggest problems are you can't pick your spots. You can't pick your spots. And because you can't pick your spots, you have to do literally all of these, have a huge sample size to be able to get the numbers that we've kind of quoted you here, which are totally accurate, and we include commissions on all of these too. So the question is there a version where you can pick your spots, right? Meaning you don't have to do hundreds or thousands of trades, and you can have win rates that are way more than 50%. So you have confidence that, hey, I'm going to do a number of these. I'm not going to do every single one, and I'm going to be confident because I am going to be winning more frequently than I'm losing. And I think we have found that. And again, what I'm going to show you, I'm just full disclosure. Everyone knows me. Again, I'm Stephen Brooks. I'm the guy who teaches people how to generate a consistent, predictable, and reliable salary when it comes to trading and investing. Buying options, which is what I'm talking about today, we don't even talk about in the six-figure salary system because, again, we want to make money every day, every week. Buying options, even though these numbers are positive, they don't allow you to do that because you will be losing more than you're winning. And unfortunately, that is going to have a lapse in your confidence, and you'll probably give up or go on to something else. But what I'm going to share with you for the remainder of this session is the best options buying guide on the planet. It is free for you. It is 10 times better than anything you've ever paid for when it comes to buying options, whether they've been indicators, whether they've been courses, whether they've been coaching programs, whether they've been alert services, which are horrible. What I'm going to teach you for the remainder of the time is based on data, is based on the psychology that I know when it comes to non-professionals and what they're acceptable to and what they're really not acceptable to. And it's going to allow you to have win rates greater than 50%. It's going to allow you to pick your spots, and you're not going to be doing hundreds or thousands of trades every single year. And I promise you, in fact, at the end of all this, give me a couple comments in the chat box if you think that for the remainder of this. So I just proved to you why you can't really buy options in the way you thought, even though we were able to do them before earnings and kind of eliminate one of the two disadvantages that are always working against you when it comes to buying options. Although we've already done that, and although we've already come up with methodology that does have a positive expected return per trade, it's still not realistic for you because you can't pick your spots and you have to be acceptable, which no non-professional in the world is, with win rates of less than 50%. So what I'm going to share with you for the rest of this is 10 times better than anything you've ever seen when it comes to buying options, any course, any indicator, any alert service, especially when it comes to buying options. So here it is. We did the same stocks, so the top 100 stocks based on volume, going all the way back to 2007 to present. So we have like a 13, 14-year sample size. No, it's way bigger than that. It's like 16, 17-year sample size. My math sucks. And we did a comparison. So originally, we bought the 40 Delta call option 3 trading days before the earnings announcement. We did it in the expiration cycle closest to 7 days, and we placed a 40% profit target and a 40% stop loss. And again, that returned about 6% per trade, but it did come with a win rate of less than 50%, which means it's not going to fly for you. But here's what we did. Instead of doing it every single time there was an earnings announcement, now what we did was we compared doing it only when the last time the stock announced its earnings. The next day, the stock was up over 5%. So Tesla announces earnings today. They're amazing. They're selling more cars than ever. They're going to, do dividend or buyback stock. The stock closes the day up 6%. This would trigger us to do the trade for the next time. Conversely, if Tesla announced earnings today, they were awesome, but the stock was only up 2%. In the comparison, in the second one here, we would not enter this trade the next time around. We only enter the trade, at least this study, and we'll see how it does, but we only enter this trade if the last time the stock announced its earnings, the day following the earnings. So if it announced in the afternoon, the next day. If it announced in the morning, that day. But the earnings announcement day and the subsequent market move, if the stock closed that day up over more than 5%, then we did this whole thing. And what you can see is now we actually have something that is realistic for the non-professionals out there. Again, this is not going to give you that consistent, reliable, and predictable income because earnings only happens about 4 times a year. Plus, a 66% win rate is still not as high as I'm used to. But if you must buy options, there's clearly a better time. So just by doing it only when the last earnings announcement resulted in the stock closing that day more than 5% higher, we have way less trades, right? Like we have like 12% of the time we're actually in the trade. So we can pick our spots. That kind of checks that first one. We have a win rate of 66%. Now we are winning 2 out of every 3 trades, right? Non-professionals can handle winning 2 out of 3 trades, especially when the average trade is an 8.64% return in 2 or 3 days. And the annualized return is like a 50% improvement on what it was before of 725%. So based on just the pure data, again, I want to kind of show everyone how we took this full circle. Buying options sucks because you have 2 things working against you all the time, right? You have to be right on the direction and the timing of that move. If you do it before earnings, you don't have to be right on the timing so much or the pace so much because implied volatility offsets theta decay. Now, just doing it 3 days before every single earnings announcement does show a positive expected return per trade, but the win rate less than 50%, which means you won't stick with it. Same thing with the 7-day. Positive return per trade, but you won't stick with it because you'll be losing more often than you're winning. Same thing with 14 days until the earnings announcement. Again, positive return per trade, but you will not stick with this because you will be losing more often than you are winning. Ultimately, even though those results showed positive numbers, you won't stick with it because they have win rates of less than 50%. And you can't pick your spots, which means in order to get these kind of results, you have to do like hundreds and hundreds and hundreds of these trades every single year. So a way to get around that, a way to get a win rate of over 50%, a way to be able to actually pick your spot is to only do this trade if the last time the stock announced earnings, that day, again, if it announced in the afternoon the next day, if it announced in the morning that day, but that day, the stock was up over 5%. Now we have something that you win 2 out of every 3 trades historically, and you have a 50% improvement on the average trade and the average annualized return. So this is Again, this is way better than anything you'd ever pay for. Any guru, any alert service, any indicator when it comes to buying options. Substantially better because, again, I've taught 6,000 people how to do this. You do need to win more than you lose. And you do need to be able to pick your spots because not everyone has a giant portfolio. So clearly, buying these options, these call options, three trading days before a stock announces earnings, only when the last time the stock was up over 5%, that clearly is something that you can do. Again, it's not going to give you the kind of results that we get in the six-figure salary system, which is like make money every day, make money every week. But if you are one of those people that you have to buy options for whatever, there's clearly a best time and a best approach to going about it. Now let's look at the 7-day. Again, same thing as we did before in the 7-day, but this time, again, we kind of did that extra bucket of did the last earnings result in the stock closing more than 5% higher? And as you would expect, the results are better. So we have about a 65% win rate. So again, winning 2 out of every 3 trades. That's major improvement because if you're winning 2 out of every 3 trades, you can actually stick with something. And then, again, you're really doing only about 10% of the trades you were otherwise doing, which on a 794 divided by 14, you're only doing 50 or so of these a year, which means you don't need a giant account, right? You only need a reasonable size account to be able to do this because there's only about 50 of these a year based on the fact that we were in a 16, 17-year sample size. So you can do this as a non-professional because you don't need a huge account to only do 50 of these in a year, and you will be able to stick with it as a non-professional because historically, you're winning 2 out of every 3 trades. So in the 3-day example, we got a huge benefit. A 50% improvement on the average trade, and 2 out of every 3 trades was a winner in the study. Same exact thing on the 7-day. Now, some of you are probably asking, well, what about the 40-day, the 14-day? Well, let me write this correctly because that wasn't written correctly. Now, what about the 14 days before the stock announces earnings? What does it look like? Well, again, like basically what you thought it was if you paid attention during this video, right? The win rate, 2 out of every 3 trades. The average trade, in this case, is about a 25 to 30% improvement. But you're only doing about 50 of these during a given year, so you can pick your spots. And because you are winning more than you're losing by a good margin here, you will be able to actually stick with it. So again, this is something that is truly realistic for the non-professional. And again, I teach people how to generate a 6-figure salary. We do that like every day, winning 70, 80, 90, 95%. We definitely don't buy options in in those systems. We definitely do not buy options in those systems. But for the people who have to do it because whatever reason, clearly there's a best time to do it. So at the end of the day, the moral of the story is kind of this. While it is enticing, right? These numbers are accurate. Right? While it is enticing to see numbers like this and be like, oh my God, it makes 6% per trade in 2 days. Or, oh my God, it makes, 6% in 7 days. Or, oh my God, it makes 15% in 2 weeks. It's not going to be realistic for you at all because, again, they have win rates of less than 50% and you have to do so many of these to the point where you cannot pick your spot. But if you do it only when the stock, based on its last earnings, the stock was up 5% or more on that day. Again, if it announced after the market closed, the next day. If it announces before the market opens, that day. It kind of means to me that if a stock most recently had really good earnings and the market reacted really well, the market is front running that the next time around. And it only happens about 50 times in a given year based on the top 100 stocks based on volume. It's something that wins about 2 out of every 3 trades. So you'll actually be able to stick with it. And it's something that has a positive expected return per trade. So this is something that is actually attainable for the average non-professional. This is something that is actually attainable for the average non-professional. This is something that is actually attainable for the average non-professional. Why? Because again, the win rates are 2 out of every 3 trades historically. And at the same time, it's a positive outcome per trade. This is something that, again, while it is not what we teach in the 6-figure salary system, because honestly, that's way better. This is something that if you must buy options for whatever reason, I still don't understand it. But if you must buy options, there is a clear best time to do it. And again, this information is way better than any guru, any course, any indicator, all that stuff, because most times it absolutely sucks to buy options. There are windows where you have only one thing working against you, where it's normally 2. And then there are specific types of setups within those windows where, hey, we get the improvement on the win rate that we need to actually continue forward with it. And we still have those positive expected results, meaning they're actually kind of realistic for us. So again, my name is Stephen Brooks. I teach those who manage their own money, manage their own portfolios, whether they're traders or investors or beginners. I teach them how to make a very, very, very reliable and predictable 6-figure salary, really trading less than 2 hours a day. If you're interested in learning more about that program and how you could potentially earn a 6-figure salary trading from your home in less than 2 hours a day, go ahead and click on the link that I've added to the description of this video. And if you're not, and you like buying options or whatever, this is something you should seriously, seriously take to heart, because the market can be difficult if you make it difficult. And the market can be easy if you make it easy. The good news is you can choose either of those. You can choose to make a market easy, or you can choose to make a market difficult. I choose to make it easy. I don't know about you, but it's hard enough. So I choose to make it easy. There's a clear window. And within that window, there's a clear setup of when buying options actually works to the level that is realistic for the average non-professional to be able to do it. So again, my name is Stephen Brooks. I teach traders, investors, those who manage their own money, how to make a reliable and predictable 6-figure salary, really trading in less than 2 hours a day. Again, if you're interested in that, go ahead and click on the link in the description of the video, book a call to speak with somebody on my team, and we'll see if you're a good fit to be able to get that result. If not, and you like this video, go ahead and give me a like, go ahead and subscribe, go ahead and click the bell so that you get notified when more amazing videos that are way better than anything you've paid for before come out. And I'll see you all in the next video.